Ever wonder how auditors unravel the complexity of financial estimates and management decisions? Dive into the world of auditive estimates and judgments where numbers meet scrutiny. Auditors peel back the layers, analyzing every assumption and figure to ensure accuracy. From revenue projections to asset valuations, no stone is left unturned. It's a meticulous process of verification, where clarity is key. So, how do auditors navigate this intricate landscape? Stay tuned to uncover the methods behind the audit, revealing the true story behind the numbers. Welcome to our course overview. Today, we dive into the world of estimation uncertainty, exploring why estimates are vital yet challenging to audit. From impairment to provisions and fair value measurements, we'll dissect key estimate types. Be on the lookout for management bias and potential manipulation signals. Discover when auditors lean on specialists for expert insights. As we journey through these critical topics, stay engaged and ready to unravel the complexities of auditing estimates. Let's begin this enlightening exploration together. In the intricate landscape of financial statements, accounting estimates stand as crucial pillars. Why do they matter? Because the future is an elusive canvas, demanding companies to gaze ahead and foresee asset longevity, debt repayments, and looming obligations. Unlike the simplicity of cash transactions, estimates are the realm of judgment, assumptions, and foresight, a necessary yet treacherous terrain prone to errors and manipulation. As auditors, our task is to scrutinize management's estimates, ensuring they are not only reasonable and supportable but also devoid of bias. In this realm of uncertainty, our vigilance shines brightest. In the complex world of auditing, not all estimates are created equal. Some are based on solid historical data and clear formulas, while others hinge on uncertain future events. These high uncertainty estimates demand heightened auditor scrutiny, meticulous documentation, and often, specialized expertise. As auditors navigate this challenge, they must distinguish between the straightforward and the intricate, ensuring thoroughness in their assessments. By recognizing the nuances of estimation uncertainty, auditors can effectively target their efforts where they are most needed, safeguarding the integrity of the audit process. What is impairment? It's when an asset's value on the balance sheet surpasses its true worth. Common triggers include market value declines, usage changes, economic shifts, and obsolescence. Auditors are keen due to estimation risks and possible profit inflation. Impairment calls for accurate reflection of economic reality. Have you ever wondered how auditors navigate the complex world of impairment testing? It all starts with recognizing impairment, comparing amounts, and determining recoverable amounts. By identifying key indicators, auditors can gain insights into management's analysis. Each step requires careful judgment and evaluation of assumptions for reasonableness and consistency. This systematic approach ensures a thorough examination of financial data. Auditors must tread carefully, balancing precision with practicality. In the end, it's all about ensuring the financial health of the entity. Ever wondered how auditors tackle impairment evaluations? Let's delve into the key procedures. First, we scrutinize indicators to ensure management flagged the right assets for testing. Next, we dive deep into assumptions, questioning inputs like discount rates and growth projections. Historical accuracy is paramount. We compare past estimates to actual results for insights. When the situation gets complex, specialists step in, bringing their expertise to the table. This meticulous approach ensures a thorough assessment of potential impairments. Remember, precision is key in safeguarding financial accuracy. Have you ever wondered what provisions really mean in accounting? They're essentially uncertainties waiting to unfold, liabilities recognized when a past event triggers a present obligation, with a probable outflow of resources and a reliable estimate in place. Think warranty provisions for fixing faulty products, restructuring costs for facility closures, legal settlements awaiting resolution, or environmental cleanups looming. These financial obligations demand attention and preparation. So, next time you encounter provisions, remember they're not just uncertainties, they're calculated responsibilities awaiting resolution. Have you ever wondered how a company determines when to recognize a provision? It all comes down to 3 key criteria. First, a present obligation must exist due to a past event. Second, it's crucial to assess the probability of an outflow of resources to settle the obligation, with it being more likely than not. Lastly, a reliable estimate of the amount involved must be measurable using the best estimates available. Only when all three criteria are met can a provision be recognized. If not, the company should disclose it as a contingent liability. In essence, it's about balancing legal and financial obligations with the certainty of future resource outflows. Ever wonder how audit provisions are put to the test? Let's walk through an example with Techco's smartphone warranty. With 5% of phones needing $80 repairs, and 50,000 phones sold this year, management estimates a $200,000 provision. The auditor's tasks? Validate the 5% rate by studying past claims, confirm the $80 cost with recent repair records, ensure all sales are counted, and consider any changes that might impact estimates. By comparing past provisions to actual costs, they ensure accuracy. In the world of auditing, precision is key. Stay tuned for more insights on effective provisions. Ever wondered how assets and liabilities are valued in the financial world? Enter fair value measurements. Think of fair value as the dynamic price tag in a bustling market. It captures the current pulse of supply and demand. From securities to business acquisitions, fair value reigns supreme, though its accuracy hinges on market intel. Auditors play a crucial role, scrutinizing valuation methods to ensure precision. In a realm where figures paint a vivid picture, fair value stands as the true north. Ever wondered how financial experts determine the value of assets? Enter the fair value hierarchy, a ranking system that sorts inputs by reliability and objectivity. Level 1 inputs stand out as the gold standard, directly derived from market transactions. On the flip side, Level 3 introduces estimates relying more on management judgment, posing greater audit risks. From concrete market data to managerial foresight, this hierarchy navigates the spectrum of valuation. Remember, the higher the level, the higher the risk. In a realm where precision is paramount, decisions shape the future of audits. Are you ready to dive into the critical process of auditing fair value estimates? First, grasp the valuation by identifying the hierarchy level and method used. Then, meticulously test key inputs based on the level, verify prices, assess observable inputs, and challenge assumptions. Next, evaluate the model's appropriateness for the asset or liability type. Lastly, for complex Level 3 measurements, don't hesitate to bring in valuation experts. Remember, a thorough audit ensures accuracy and reliability in financial reporting. Ever wonder why financial estimates sometimes seem too good to be true? Enter management bias. Here, estimates are subtly skewed to paint a rosier financial picture, whether through intentional manipulation or unchecked optimism. These biased figures can artificially boost earnings, smooth income streams, or create a facade of financial strength. Auditors must be vigilant, spotting patterns that hint at this distortion. In a world where appearances can deceive, maintaining professional skepticism is key. Remember, behind the numbers, the truth may not always be as it seems. Ever wonder how to spot red flags for management bias? Keep an eye out for aggressive assumptions, like overly optimistic growth rates or unrealistically low discount rates. Watch for inconsistency in methods or assumptions, especially if changes seem to conveniently boost results. Look for a directional pattern where estimates consistently align with management's wishes. Beware of last-minute changes with no clear justification or support. A poor track record of estimates diverging from reality should raise concerns. And weak documentation, with lackluster support or vague methodology, signals potential bias. Stay vigilant for these signs of skewed decision-making. How do auditors test for bias in financial estimates? By reviewing reasonable ranges, comparing to benchmarks, analyzing historical accuracy, and evaluating incentives and pressures. Auditors establish independent expectations and scrutinize past patterns for bias. They consider management's motives, such as meeting earnings targets or loan covenants. If significant differences arise, explanations and investigations are crucial. Detecting pervasive bias is key to preventing financial statement misrepresentation. When auditors encounter complex estimates requiring specialized knowledge, they turn to a range of experts. Valuation experts assess the fair value of intricate financial instruments, businesses, or intangible assets. Actuaries handle pension obligations, insurance reserves, and employee benefit liabilities. Engineers determine the useful lives of specialized equipment and construction project costs. Legal experts decode complex contracts and litigation outcomes, while environmental consultants assess remediation costs and environmental liabilities. These specialists bring essential expertise to the audit process, enhancing its accuracy and reliability. Ever wondered how auditors work with specialists to ensure accuracy and independence? When collaborating with experts, auditors must first vet their qualifications and experience, guaranteeing objectivity by confirming independence from client biases. Understanding the specialist's methods and data sources is crucial for assessing the reasonableness of their findings. Ultimately, auditors are accountable for the final opinion, so rigorous evaluation of specialists' work is non-negotiable. Remember, reliance on specialists doesn't absolve the auditor of responsibility. Thorough scrutiny is key. In the intricate dance of auditing, partnering with specialists requires a keen eye and unwavering commitment to quality. Estimates are a high-stakes game, teetering on the edge of uncertainty. Judgment, assumptions, and predictions pave the way, leaving them susceptible to both error and manipulation. Each estimate poses distinct challenges. Asset impairments test values, provisions acknowledge murky obligations, while fair values mirror market whims. Keep a watchful eye for management bias. Spotting red flags like aggressive assumptions and poor documentation is key. When in doubt, lean on specialists, but remember, the final verdict rests with you. Embrace professional skepticism, question, test, compare, and demand evidence. Stay vigilant, for in the world of estimates, scrutiny is your shield. As an auditor at Retail Co., you face a critical decision regarding store number 47. Despite significant challenges like declining sales and new competition, management remains optimistic about its future. Should impairment testing be considered? Look for red flags of potential bias and plan rigorous audit procedures to evaluate management's stance. Challenge assumptions in the cash flow projections and consider involving a specialist for deeper insights. Document your professional skepticism clearly in case of disagreement. Remember, in auditing, sound judgment is key to ensuring financial integrity.